Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
Welcome back. My name is Ray Sclafani. I'm co-host with my good friend Mark Hurley. Thanks for being back with us today, Mark.
Oh, it's great to be here again, Ray.
Okay, so we've got quite a lineup, what we want to talk about today. We've got an article you published in FA Mag, Look Out, Here Come the Sovereigns. We talked a little bit about this last month, but after reading your article, I had a couple of questions. I want to go a little bit deeper. It means big things for the PE marketplace for RIAs. The second topic we want to get to is this article out of Barron's where the SEC is suggesting longer timeline for the AI rule as it moves ahead with ESG and cyber. The third topic we want to get to is this second court now blocking all aspects of the DOL's fiduciary rule. There's two really good examples that when we say welcome to the jungle, what does it really mean? Focus-affiliated celebrity biz managers dismiss the suit against Galloway Holdings, and Ameriprise accusing LPL of encouraging recruits to take confidential client information. And then we've got another winner out of RIA Biz about cash backlash smacking RIA industry after custodians overreach. And then our main story is what's really going on with organic growth and what's an advisor really to do when they think about growing their businesses. So what do you say we jump right into it?
Great.
Okay, so I want to just go just a little bit deeper into this idea of sovereign debt. Advisors are thinking a lot about this private equity money coming into the marketplace, long life capital partners coming into the marketplace. In mid-June, wealth management industry has learned that Fisher Investments has sold a $3 billion minority stake to outsiders. Who are the outsiders? It's the Abu Dhabi Investment Authority, or ADIA, openly and directly investing in their firm, comparing that to a similar deal in 2023, where Abu Dhabi Investment Advisor made an investment in CI Financial's U.S. wealth unit, now called Corient, as part of a Bain Capital consortium. These might be the first among many deals to come. Now you've got these kinds of investors entering the marketplace. It's not just PE flooding the marketplace. It's these sovereign debt, family office, other long life capital partners. Take us a little bit further. Go beyond the article. What does this really mean to the industry? What does it mean to an advisor who's a CEO running their own wealth management firm today?
Yeah, well, let's understand first, the sovereigns have already been investors in the industry. They're the ones who've given a disproportionate amount of the capital to the PE firms in the first place. So they've been limited partners investing. And what's different about what happened now is that you had a sovereign fund come directly in and let its name be used as part of the investment. Now, we argued in this paper we put out in December, my partners and I, that they are probably the best possible investors for the aggregators because a sovereign wealth fund's job is to create intergenerational wealth, make investments 15 to 30 years. And where the industry right now is at this transformational point where the M&A market's gotten so efficient, you really can't make money by doing M&A. You make money by what happens after you do the deal. Where you really make money is through organic growth. But organic growth is a lengthy, messy, complicated process, requires lots of investments, lots of patience. And if you're not thinking at least 10 years, if not 15 years, you really can't have an effective organic growth strategy. Sovereign funds right now, if they start to displace some of the private equity firms that are doing the aggregators, that will make the aggregators much more formidable competitors because their current investors have, say, 3 to 7 year investment horizons, if even that long. And they're not thinking about, let's make investments and see what happens in 5 years. They're worried about next quarter, at least, if not next quarter, maybe next year's numbers. And as a consequence, as the sovereign funds start to intermediate the PE firms, I think you're going to see very different behavior out of many of the larger aggregators.
Well, there's a lot of story to come here in the future as it relates to monies continuing to flood the marketplace from outside investors, and advisors are wondering what to do. Do I stand still and do nothing? Do I take on private capital? And is this long life capital partner available to me? I hear this story over and over again. Any advice or guidance you might offer an advisor thinking about how this impacts their business?
Right. For the typical wealth manager, sovereign fund's not going to invest because they're not a large enough investment. Sovereign funds, they have $1 trillion to put them on work. And the good news is, though, there's oceans of capital out there. I mean, we talked about this in our last podcast, but PE firms are breaststroking their way through $100 bills. There's $1 trillion of dry powder they've got to go put to work. And if you have a firm and you're at the point that you want to monetize it, you're going to have numerous opportunities to put it to work, because wealth management is, if not it's one of the most attractive businesses for private capital to go into.
Okay, so let's move on to our second story. The SEC suggests longer timeline for the AI rule as it moves ahead with ESG and cyber. This appears to be a timeline that's extended in issuance and a regulatory governing how advisors and brokers use AI, predictive analytics, and other emerging technologies increasingly favored by wealth managers. Now, the commission issued its updated regulatory agenda, indicating that it intends to gather more feedback on the AI rule and more than a dozen other proposals. So a greater number of potential regulations are in the final stage of adoption. Those include one after another consequential rules for advisors concerning how to use outside contractors, cybersecurity, disclosures around environmental, social, and corporate governance issues, otherwise known as ESG. So the SEC's penciled each of these 3 rules in for the finalization in October. Now, at Digital Privacy and Protection, your company, I know you've got a paper coming out in September on cyber, but this is a real sea change for the SEC, and it's really signaling a set of priorities and what's to be expected. What's your inside baseball on what's really going on here?
Well, first off, trying to interpret what the SEC does is somewhat analogous to predicting what the Vatican's going to do. A little bit opaque.
Hey, now, come on. Don't attack the Vatican, Mark.
The SEC published in July a list of rules that they expect to finalize this year. They took an enormous number of rules and kicked them off to 2025, but they made it quite clear there were 2 in particular that impact RIAs that they hope to get done in October. But no one knows if they're going to get this done. I mean, unless you're in the agency, you really don't know. And even if you're there, you may not be sure. That said, they proposed these cybersecurity rules back in April of 2022. Then they extended the comment period in August of 2023. So they're long overdue to get these out. And the cybersecurity rules themselves are going to fundamentally alter the way wealth managers have to operate. They put them in a very, very difficult, maybe even a precarious position, because wealth managers are probably the ideal targets for cyber criminals. The question is will these rules get finalized in October, November? Who knows? But they're going to get finalized, because every day someone's getting hit and millions upon millions of dollars are being stolen.
It's not a question of if, it's when. I mean, we at ClientWise here, we're coaching advisors and hear stories that are alarming. $2 million wired to the client. Advisor and the team did everything right, verifying the client's voice over the phone, only to find out some AI robot took their voice from online YouTube videos and Instagram posts, and they fraudulently created a voice. This is scary. I mean, this is happening over and over again. We're hearing more and more stories about this.
Yeah, you touched on deep fakes as a good example. 8 months ago, if you were in the cyberspace and you talked about deep fakes, it would be almost like science fiction. There's now even a YouTube video which shows you how to make a clone of a voice and an image you can use on a Zoom call, and it's extraordinarily accurate. There's even a website now for $4.95 a month. You can sign up for a service where you can take anybody's voice using AI software and clone it, and it'll be accurate enough to defeat voice recognition software. So all the traditional means of confirming transactions are out the window. Now, the bigger issue with these rules that the commission has proposed, and which we think will be final relatively soon, is that they don't distinguish between being attacked directly or indirectly. In other words, yes, if someone gets into your systems, you got a problem, but they don't care if someone came in through a client, came in through an employee working remotely, you're on the hook regardless. And this is going to change.
And you've got to disclose it, right?
In fact, it's like, as I call it, the face tattoo of wealth management, because you're not only going to have to disclose it, you're going to disclose it to every current, future, and prospective client.
That's
What
scary
happened,
business.
why, and how much money was lost. I mean, you want to talk about damaging trust with clients, have something like this happen. And every day we're talking millions of dollars. This is not, and it's not just, for example, custodial accounts. Bank accounts are getting hit. We were brought in to help a family that lost $360,000 out of a Chase account. Retirement account, $3 million. Home closing, $2.5 million. In every case, the wealth managers are caught in the middle. And under the new rules, the wealth manager is going to have to self-report to the SEC within 48 hours. So it's not even like, oh, gee whiz, we got this fixed, let's hope it goes away. No, you're going to have to pick the phone up and call your regulators, and then things are going to get exciting, not in a great way. This report that we're going to be putting out in right after Labor Day is designed to help people think about this issue. It's intended for CEOs of firms, not for the IT people. They can read it too. It provides a framework so you can understand, okay, what are your risks? What are your obligations? Who are the bad guys? How are they going to come after you? And then on top of that, we've developed a set of detailed protocols that firms can use to actually protect themselves.
Well, I would suggest maybe our September episode, we dedicate the time to this topic. I know you and Brian Hamburger, are working closely at Market Counsel on what's an advisor to do.
That's right. This is designed to help people think through this and come up with a plan for their firm.
Okay, terrific. So more to come on that story. Let's move on to the third topic today. A second court now blocks all aspects of the DOL rule. A group of insurance industry groups have succeeded in getting the DOL's new fiduciary rule and prohibited transaction exemptions temporarily blocked. A federal court issued a stay in the effective date of the DOL's regulation and amended exemptions. This is a pretty interesting time for the DOL rule in the marketplace.
Yeah, I think, and we talked about this on our last podcast, but one of the more earth-shaking rulings that the Supreme Court issued that kind of got overlooked given all the political drama going on in our country right now is the reverse what was called the Chevron case. Now, back in 1984, the Supreme Court ruled 6-3 that if a law was ambiguous, the regulator's job was to interpret the law. And if there was a disagreement between how the regulators did and the person who was being regulated, you would go to an administrative law judge who was an employee of the regulator who would make a ruling, kind of like an internal arbitrator. And the only way the courts could overturn that ruling is if they found that the ruling by the judge had been either arbitrary or capricious, which is a unbelievably high standard, almost impossible to get over. So this gave an enormous amount of power to the regulators. The Supreme Court, over the time since 84, over the last 40 years, kind of watched what's happened. And as is typical in any form of government, things go to extremes. And the court revisited the issue and decided, no, that was a mistake that was made 40 years ago. The real authority under the Constitution for interpreting laws are the federal courts, and we shouldn't give away this authority. And in fact, if you read the dissents on the case, they basically said, well, this just caused a lot of disruption. It wasn't like it was fundamentally, inconsistent. Well, what does this mean for everybody in our industry? Well, DOL, for example, attempted to say that under a rule they put out before this Chevron ruling was reversed, they went out and said that if you're dealing any way with retirement accounts, whether you're a broker or insurance, anyway, we're effectively going to say you got to be a fiduciary. And clearly it was an aggressive approach by DOL, I guess is the polite way to call it. Two federal judges blocked the implementation of the ruling, saying that it's overwhelmingly likely it's going to get reversed. What this means now going forward is that regulators are going to have to think in the context of not just can we convince one of our own employees we want to do this, can we convince a federal court this is how the law should actually be interpreted?
This is going to have a reverberation in our industry in a big way. There's no doubt about it. When I think about the fiduciary rule, George Kinder just called for a new fiduciary rule. I always think of George as the grandfather of the life planning movement and a real fiduciary setting the tone in our industry. And he has a new book out called The 3 Domains of Freedom. I'd encourage our listeners to maybe pick up a copy and check it out.
Yeah, I mean, George is obviously brilliant.
He's been doing it a while. So, okay. So anything else on DOL before we move on to the next topic?
No, but again, we're going to see more rules come out. What I think you're going to see is the stuff that's more politically oriented will have a harder time going forward than the stuff that perhaps is more commonsensical. But let's be clear. The regulators want to do something, they can do something. All you're debating is now, can you go to the federal courts or not? That's the difference.
All right. So in your white paper published earlier this year, Welcome to the Jungle, you talked a great deal about what was once a comfortable, warm, collaborate, and collegial industry getting a little tougher. There are a couple of really interesting stories coming out. Focus-affiliated celebrity business managers dismiss the suit against Galloway Holdings. This one really gets your attention if you're thinking about what it really means when you say welcome to the jungle.
Yeah, you have a firm that was acquired by one of the aggregators. Some of the colleagues in the firm decided they wanted to get out. They tried to have some sort of deal made to buy them out. They couldn't work the deal out. Then the person who was one of the bidders allegedly poached some of their employees, involved people in California, so restrictive covenants are a little more harder to enforce. Now we got everybody suing everybody and, trying to invent any possible reason to sue each other. This case itself is emblematic of where the industry is heading at an accelerating rate. In fact, even faster than we even thought of when we published the paper in December. This has always been a great, genteel club. We all get together, we share ideas, we work together, we hold hands, we sing Kumbaya. Now it's turning into a war. And what's driving the war is there's a finite number of really talented people out there, and it takes forever to develop new people. And the only way to go get them is to run up to Jolly Roger and go poach them. And what people are doing is suing each other. I mean, I think every time we do this broadcast, there's another 5 or 6 lawsuits coming on. This is very quickly going to go from being, a country club setting to the Russian front. Claw, bite, scratch, fight.
You've got another interesting lawsuit that came out this week. Ameriprise accusing LPL of encouraging recruits to take confidential client information. What caught my attention about this one is related to the talent, but also the clients. Here's a not only federal securities laws, but it's also the protocol for broker recruiting, which is an industry truce that was signed by many firms, in this case, both LPL and Ameriprise, allowing departing advisors to take a limited amount of data, such as client names and numbers, when moving firms. So this one, it's just interesting. It's another example of welcome to the jungle and more lawsuits to come, with a declining number of advisors entering the marketplace and a need for roughly 70,000 more based upon the growth expected over the next 15 years.
Yeah, and if you're one of the listeners and if you're an advisory firm owner, let's understand, okay, it's not just can you sue somebody, can you prove damages? And how do you quantify those damages? And how long does it take to get through the case? And how much damage do you do your firm while you're going through all of this? This is why one of the things we argued robustly in the paper was that you can't think of this simply as litigation is going to protect you. What you're going to have to do is create a set of financial incentives, create certain opportunities for key people to build wealth, and make it so it becomes irrational for them to want to leave, as opposed to simply saying, we're just going to sue you.
Okay, so let's, my favorite segment here, because you always get my attention when we do this, is the You've Got to Be Kidding Me segment. Another interesting article, winning article coming out of RIA Biz. Cash backlash. I mean, this is like so salacious. Cash backlash smacks RIA industry after custodians overreach and investors and trial attorneys signal that a wink on raking spread profits on loose cash got violated. Schwab, Morgan Stanley, LPL, Wells Fargo are among the firms feeling the heat and facing the conundrum around over-reliance on a chief revenue source. Even better was Brooks' note. The most despised payment for services in the wealth management business is a fat sales commission. Next on the list is perhaps a fee that can be identified. Third on the list is a revenue source that has no price tag, but can amount to hundreds of basis points, especially in a high interest rate environment, spread capture. But just because it's third doesn't mean that consumers of wealth management aren't waking up to the practice, or maybe their lawyers woke them. Either way, they're awake now and it's game on. It's fun to get outraged about it, but somehow custodians will still need to get paid. I mean, this is crazy, this headline.
What are these guys smoking over there? Okay. Let's talk about the article accuses them of skimming from client accounts. Skimming is what the mafia did in Vegas. Okay. That's what skimming is. They go on to say that, and this is my favorite, the regulators let the BD steal a little bit through disclosure, but now they're stealing too much. All right. Come on. we're talking about accounts have extra cash in it at different points in time. When you sign your custodial agreement and your advisor reviews this and looks at this, they say, hey, if you have some extra cash, rather than sitting fallow, we're going to invest it so you get some sort of return on this. This whole article is about that. Did they get a high enough return on their cash that was just sitting fallow anyways? Not that something was created, there was some sort of sneaky, nefarious way to steal from them or skim. And you're talking about a phenomenal organization like Schwab. This is an organization that really created the opportunity for the wealth management industry. And it has been so much on the side of clients forever. To suggest something like this is just, it's so absurd to be outrageous. I mean, how can you say this kind of stuff about these organizations? But then again, this is RA biz. They check.
All right.
Check.
In fact, check again. Let's go back and talk about growth. I know we touched on it briefly, but I want to dig into this main topic for today and switch gears here and move on to an article that Philip Palaviv of the Ensemble practice published in FA magazine. Growth, time to point some fingers. Now, I'm a big Philip Palaviv fan, and the Ensemble practice is a tremendous organization. We collaborate with them in the marketplace with a number of institutional clients. Earlier this year, the Ensemble practice launched their inaugural True Ensemble Data Insight Study, and they analyzed a wealth of data received. Their initial looks uncovered a very interesting and perhaps concerning growth trend. In 2023, the independent advisory firms participated in the study grew their assets under management by 20.3%, and their number of client relationships grew by only 8.3%. This year, firms are hoping to keep that momentum and target another year of 20+% growth, but it seems we're placing our hopes in the market rather than the ability to add new relationships and more assets from existing relationships. So some insight and some data maybe pointing to emperor has no clothes, and the advisors are riding the wave of the capital markets and not exercising the muscle of organic growth. What's your take?
Well, one of the things we talked about in the study, and it's continued to this day, most of the so-called organic growth has been the market going up, and the second most has been existing clients giving more assets. First off, anything that Philip Palaviv writes, I want to read. Guy is unbelievably smart and insightful. And he dared use this trigger word called accountability. He says, look, if you're going to get organic growth going in organizations, you're going to have to demand accountability. And because we had this roaring bull market from 2012 to 2021, where on a inflation-adjusted basis, the average client portfolio that was diversified compounded at a rate of more than 10% a year, which meant that RIA EBITDA went up 15 to 20% a year just for turning the lights on, not where they got any more clients. People got comfortable making tons of money. Everybody was a genius. Well, okay, I too missed that period. But assume we don't get another extended roaring bull market, at some point, the way you're going to be able to grow the business is by adding clients. And to add clients requires a very different sort of psychology within an organization. One of the custodians, in fact, did a study back during the 2012 to 2021 period, and they found that, but for the market, 70% of the firms that they custodied for would be shrinking.
Well, what's even more alarming is the rest of those that were growing, the majority of their growth came vis-a-vis acquisitive growth. It wasn't organic at all, adding new clients to the account.
Yeah,
and to the firm.
A public company, an attempt to cover up, for lack of a better term, their lack of real organic growth, they decided in their disclosure as to what they called organic growth, they said, we count M&A as part of our organic growth, even though that's really not adding clients, it's spending capital to buy firms.
You know, I was reading some of the data coming out of the Schwab study. I know Lisa Salvi does an amazing job at Schwab. They do a great job at collecting and analyzing data. There's a bit of a contradictory sort of notion. And as I delved deeper into the data, I noticed that their survey among organic growth pointed to the fact that in 2023, AUM increased 18%, revenue was up 6%, and client growth was up 4% at the median. So interestingly enough, they're highlighting that growth maybe is really happening, but they're also pointing out that similar to what Philip's identifying is the number of new client relationships coming in aren't really growing at the rate. And this is also consistent what I've heard from our team over at Barron's, which is 2/3 of net new flows among the top ranked advisors coming in or vis-a-vis existing clients adding assets. So while we may see that kind of organic growth, existing clients adding assets, We also are seeing capital markets are screaming this year. The S&P's up at this point, 17, 18%. Maybe much of it is really masked, the organic growth, by what the capital markets are doing and what advisors have done, which is pick good clients that stay a while and continue to grow their accounts.
Yeah, well, the last week or so, shall we say, the market gives, the market takes back. But I think the real challenge here is a cultural challenge. There are several large organizations, I can think of right off the top of my head, that do a phenomenal job on organic marketing, organic growth.
Let's run through those. Merit, Financial.
Beacon Point, it's almost to the point of insanity how fast they're growing.
Wealth Enhancement Group, right? Jeff Decco's team.
Marty, Mariner, same thing, and of course, Creative Planning, which is the King Kong of the whole bunch.
Peter Mallouk has really built an incredible arm of organic growth internally.
Amazing business. The problem is that they are capturing the disproportionate amount of this opportunity. There are one of the more interesting statistics that we came up in writing the paper was that there are now 7 million more Americans between the ages of 45 and 60 than there are 60 to 75. Now think about for a second what that implies. It means the absolute number of clients in this industry are going to more than double over the next 10 to 15 years.
And there are 70,000 advisors needed in this great profession. And last year we hit the first slide where more advisors left the industry than joined the industry. Right at the same time, we've got the most number of CFPs in the US and the most number of graduates of CFP programs in the US. So something's afoot.
Well, there's such an enormous economic opportunity here. The challenge, of course, though, is a CFP graduate is nowhere ready to be an advisor. This is being an advisor.
Not yet, but are advisors taking the long view? That's, I think, the challenge to think about.
Smart ones are. I've always thought that Peter's view of the world is 100%. The present value of 100% market share is infinity, and he's on the way trying to get 100% of the market the way he's going. I think that the firms where the owners have very long investment horizons and they're very decisive, and we listed a whole bunch of them. These organizations are making the investments necessary to grow. They're taking all the steps. They're getting out way ahead. And more importantly, they've created cultures and incentive programs that are very focused on this. Most of the industry, quite candidly, is somnambulate. They just rode up the wave with the market going up. Who needs to get new clients? Your EBITDA goes up 15 to 20% a year for turning the lights on. God, it's so hard to get clients too. You got to get out there and get rejected and build these networks.
You talk about accountability. In Philip's study at the Ensemble Practice, close to 58% of advisory firms don't even articulate individual growth targets for the advisors in their firm.
Imagine one of these guys taking over an aggregator that has many firms that quite candidly have stopped marketing for more than a decade. How do you get them restarted? What a leadership challenge. And the people that can pull that off are going to be extraordinarily successful. The reason why we talked earlier about the sovereign fund money coming in is that the management of these firms, when it's the sovereign funds, can take a much longer view than when it's a PE firm that's worried about selling in the next 3 to 5 years.
Okay, so I want to highlight, though, this is interesting to me. We've been thinking about this topic of organic growth a great deal at ClientWise, and we've been working closely with the billion-dollar business firms that we're coaching and asking them the question, how fast should you really grow? So I pulled an article earlier this year published in the Harvard Business Review by Gary Pisano, and I want to highlight just a couple of things that he pointed out. He and one of his research partners did a long study. They took 10,897 publicly held U.S. companies from 1976 to 2019. He and Catherine Piner did this study. And here's what they found, that firms in the top quartile grew at an inflation-adjusted average of 11.8% per year, but those in the lower three quartiles experienced little or no growth, 0.3%, 0.03%, and negative 0.5% respectively. The majority of firms in the top quartile were unable to sustain superior growth performance for more than a few years. So let me ask you the silly question. Are we just expecting a very few firms in the RIA channel to grow at all, considering maybe the trends in companies in the U.S.?
Well, it's a bit of a tautology. If you can grow, you become a big business. But the real we're talking about is the transformation of the business. It's going from being a proprietorship to a real business. The marketing's going away from just the founders to the whole organization. One of the really insightful comments I think you made in our last podcast was that if you want to figure out the age of most firms' clients, just look at the age of the founders, because they
in fact, Owen Dahl, who runs our valuation services, he has pointed out that there's a direct correlation, more than a 90% correlation between the age of the advisor and the age of the client.
And what's happened there is all the marketing efforts have remained focused on the people who are the founders, as opposed to the organization. If you can get the change the culture, you can create the right accountability, create the right marketing strategy for the whole organization. The opportunity is so enormous that you very quickly go from being a relatively small firm to, quite frankly, a very big firm.
You know, Mark, one of the things that we've observed, in fact, when I did the research for my first book, You've Been Framed, How to Reframe Your Wealth Management Business and Renew Client Relationships, we identified this very important trend among those firms that were growing well organically, and that is that they were institutionalizing their business development, that they were no longer relying just on one or two or three advisors in the firm to knock on the door and get the referrals. And look, we know anywhere between 70 and 90% of net new relationships coming into a firm come vis-a-vis an introduction, either from a client or another professional, a center of influence. But yet the firms that have moved beyond that, continue that, document what your process is for introductions from clients and building client advocates and introductions from professionals and centers of influence, but move beyond that. After you document that, begin to think about how to institutionalize the business development through digital marketing and inbound marketing. You can see Rick Edelman and Ron Carson and others, Deco with Wealth Enhancement Group, radio shows. We see Peter Maluk. I'm seeing creative planning ads now. Fisher Investments talking about fiduciary standards. Whether their strategies are right or not, and you agree with them or not, it's very clear the best in the business are building this institutional prowess in generating leads for their firms and asking their advisors to close and win the business as opposed to have to just generate the lead. That's a big trend we see.
Yeah, Michael Kitces, who I view as one of the smartest guys on practice management anywhere, he pointed out that most firms have a self-inflicted wound type of recruiting structure. What they do is they set up their compensation so that if you're very good at bringing people in, you build up your own book of business. And then over time, you get paid on that book of business. So at some point, the incentives to get more clients go away because you're making lots of money. Service clients is a fraction as far as getting them.
And you end up with a bunch of advisors in your firm that are hoarders.
That's right.
And they don't want to give up anything.
And then everyone else, quite candidly, is not that good at marketing. And as he calls it, it's the way of limiting the scalability of your own business by doing this. Now, the way you get around this is you professionalize by function. You have people that are very good at marketing, you have very good people at closing, et cetera. Yep. But how do you take people who are already making a lot of money, very comfortable? I mean, if you try to force them to change what they're doing and change their comp structure, you're going to have a prison riot. So,
I would argue that you can't really transform that way. In fact, here's what we're seeing among advisors. If you think about, a sales professional, somebody doing business development, I was just listening to Joe Duran on a podcast this morning on a run, and he was talking about this idea of, getting back into sales. Sales used to be a dirty word in the RIA channel, but business development, finding new business is something that the best need to be focusing in on. And of course, you and I agree in that. And that's why we're talking about it today. But the idea of a salesperson or a business development professional, that's not a unicorn. If you look at an advisor, somebody who's got great relational skill, great technical skill, can connect with clients, build financial plans, build and construct investment portfolios, lead a team of professionals that are providing advice and guidance to clients, that's not a unicorn. But when you mash them together, that's like a unicorn.
Yes.
It's very difficult in my observation after more than 30 years in the industry. You look at advisors that are great business developers, relationship managers, technically proficient in providing advice and guidance and leading a firm. Man, that's like a lot of hats to wear and functional roles, and separating these roles, sales, business development, marketing, advising, leading. As businesses grow, advisors want to think about how to expand and bifurcate these roles so that they can grow organically in a way that they need to.
Yeah, we call this in the paper professionalization by function. And if you look at any other industry, this is what they evolve to. Otherwise, they don't survive. This industry, because we've got such a roaring bull market and quite candidly, so many clients and they're so stable, businesses have been able to survive without having to do this. But over time, they'll diminish in value. The organizations that will create the immense enterprise value are the ones who achieve this.
Okay, so Mark, I've got an actionable idea that I want to share with you and to the listeners, and see if this lands okay. See what you think about this. If we look at an advisory practice and say to the leaders of the business, consider your 3-year rolling CAGR and look at your growth rate and strip out anything that's acquisitive. So, and if you acquired any kind of businesses, let's take that out for a quick moment. Then let's take out any capital market performance, and then look at the assets and growth that came vis-a-vis existing clients, adding assets and what that increase was. Let's set that aside and solely focus on new relationships, new assets brought to the firm. And what's the growth rate of that business? That's the real sign of a healthy business. And in fact, if you're a firm with 500 million in assets, $1 billion or more in assets, take 10% of your total assets and set that as the target of organic growth. Anything that comes vis-a-vis an existing client is accretive. Anything that comes vis-a-vis capital market growth is accretive. Anything that comes via acquisitive growth, that's accretive. But the real measure of success is honing in on this 10% target of existing assets. And I worked with firms that are 10 billion and more, and we've identified that 10% of their total assets as a target, $1 billion in new assets. And it's achievable when you create that accountability structure and pay attention to it and build campaigns around that. I'm just curious what your take might be as I share that actionable idea.
Well, I think it's a great idea. I think it also will be shocking, depressing, however else you want to call it, to many firms when they do the analysis.
It could be, sure.
Well, they're going to find out their organic number is close to zero. Their true organic number. Now, that means there's an opportunity. They should take advantage of it. And any firm that could do what you're suggesting, oh my goodness, they're going to be building incredible amount of value in the organization. But again, from where they're starting, it's going to be a big challenge.
Mark, this won't be the last time that we talk about organic growth. The OG strategy to driving enterprise value, I think, is all about organic growth, growing profits, growing revenues and people, all key to success. So we'll talk more about that, I'm sure, in episodes ahead.
Looking forward to it very much.
All right, Mark. Hey, have a great rest of the summer, and I'll catch you next month.
Looking forward to it. See you then.